Welcome to the Deep Dive. We've got some really interesting excerpts here from this text, AAVJOTK.pdf.
Oh, yeah.
From like 2007.
Okay.
And it was an accounting master's program text.
Oh.
So this is like some deep stuff.
Right.
But the listener sent it in and said, this is really the foundation of like what I need to understand
Interesting.
to really get accounting theory.
Awesome.
So we're gonna dive in with you on that.
Great.
So let's just jump right in.
Yeah, let's go for it.
So it talks about kind of like the structure of accounting theory.
Okay.
And it kind of breaks it down into these like 4 levels almost.
Interesting.
And it's almost like building a building, you know?
Yeah.
You start with a foundation.
Yeah.
And then you work your way up.
Okay.
So the foundation is the objective. Like why?
What's the purpose of it?
What's the purpose of even having accounting?
Why are we doing this?
Yeah, why are we doing this?
Yeah.
And basically the objective is to provide like useful information for decision making to investors and creditors.
That makes sense.
So like if you are going to loan money to a company, you want to know.
You want to know if they're going to be able to pay you back?
Yeah, they're going to pay me back.
Right.
So that's like the base level.
Okay, the objective.
And then it goes up to assumptions.
Okay.
And like one of the biggest assumptions in accounting is the going concern concept.
Okay.
Have you heard of that?
I have.
So basically that's the assumption that a company
That they're going to continue to exist.
is going to continue to exist in the foreseeable future.
Right. So we're not assuming they're going to liquidate tomorrow.
Right. We're not assuming that.
Yeah.
Like everything's going to be sold off.
Right.
Like we're assuming that there is a future.
Yeah.
And
this company.
we're going to use this information to make decisions about the future. So that's an assumption that we make.
Interesting.
Then you go up another level to principles.
Okay.
And I feel like this is where
the rubber hits the road.
Yeah, you start getting into like the historical cost principle, where assets are recorded at their original cost.
Okay, so that's like a principle that we're going to follow when we're putting together these financial statements.
Yeah, and it makes sense because it's like verifiable.
Yeah.
You know?
It's reliable.
Reliable. It's like, this is what we paid for it.
That's what you paid for.
This is what it is.
Yep.
And then finally, application.
Okay.
Which is like basically where the principles are put into practice.
Okay.
Through like standards and methods.
That makes sense. So it's like the actual like doing the accounting. Yeah. Like the nitty gritty like the day to day.
Okay, you want to record this asset.
Yeah.
We're going to record it at its historical cost.
Okay.
We're going to use this method for depreciation, you know?
Got it.
So it's kind of like that.
So those 4 levels build on each other.
Yeah, from a very high level to like very detailed.
Exactly.
Yeah.
Very cool.
So then they talk about kind of the approaches to building accounting theory.
Right.
There's like a whole bunch of them.
Is there one that like jumps out to you as like particularly interesting?
Yeah.
Okay.
I think the pragmatic approach.
What is that?
Is fascinating.
Okay.
Because it's basically looking at what accountants do. Like what is actually happening in the real world.
Yeah.
And then building theory based on that.
Okay, so it's like observing the practice and then building the theory from that.
Yeah.
Okay.
Like looking at what works.
Interesting. So like GAAP would be an example of that?
Yeah.
The generally accepted accounting principles?
Yes.
It was like those emerge
from what accountants were doing.
What accountants were doing.
And what worked in practice. Practices that were effective.
Okay.
You know?
That makes sense.
Like, for example, accounting for goodwill.
Oh, yeah. That's a tricky one.
It's very tricky.
Yeah.
Like,
how do you even measure that?
How do you know, and that's evolved over time.
Yeah.
As we've seen like new situations arise and we're like, okay, well, this isn't working.
Right. We need to adjust.
We need to adjust it.
Okay.
You know, and now they're saying don't even amortize it anymore.
Wow. So it's constantly changing.
Constantly changing. Yeah.
Yeah. That's interesting.
Another approach that I thought was really cool was the ethical approach.
Ethical approach. Okay.
So this one is like less about
the numbers.
Yeah. Less about
specific numbers
and more about like fairness and truth and justice.
Yeah.
Like recognizing that accounting information like impacts
people.
Real people.
Yeah, investors.
Yeah.
Creditors.
Employees.
Yeah. Even like economies.
Entire economies can be impacted by how we report.
Yeah.
You know, financial information.
Yeah.
So it's really important that we're doing it.
Ethically. Okay.
And so principles that kind of fall under this are like conservatism.
Okay.
Which is like not
overstating.
Yeah, like not getting ahead of ourselves, not overstating assets or income.
Okay.
And then substance over form.
What is that?
Which is like...
I've heard that before.
Basically, like...
I don't really know.
Looking beyond like the legal structure of a transaction to the true economic impact.
Okay, so like what's really happening, not just...
it's just how it's like...
What's the paper say?
Written down.
Yeah.
Okay. And like a good example of this is like choosing between operating lease and finance lease accounting.
Okay.
Because the legal form might not reflect the real economic burden or benefit.
Interesting. So it's like looking at like the bigger picture, the reality of the situation.
Yeah, and like what's really going on.
Not just the technicalities.
Yeah. Another one that I think is really relevant, especially today, is the predictive approach.
Okay.
So this is using like financial information to like predict the future.
Oh, wow.
You know, like...
That's a little scary.
A little scary, but also
powerful.
Really
powerful.
Cool.
Yeah.
And we see this in like models that predict bankruptcy.
Okay.
Like Altman's Z-score.
Okay.
And Beaver's model. Like those are using...
Financial data.
Accounting data.
Wow.
To...
See if a company's going to go bankrupt.
Assess the health of company and see if they're...
That's really interesting.
Headed for trouble.
So it's like applying what we know about the past to predict the future.
Yeah.
That's
So we've got these like different approaches to building accounting theory.
Yeah.
But they also talk about some specific like
concepts.
Yeah, like that fall within these frameworks.
Yeah.
And one that I thought was really interesting was constant purchasing power accounting.
Okay.
Or CPP.
What is that all about?
So this is basically like dealing with
inflation.
Yeah. When you've got like...
Prices are going up.
Yeah, prices are going up.
$1 today isn't worth $1 tomorrow.
Right.
Or yesterday.
Yeah.
Right, okay.
How do you compare?
Yeah. How do you compare...
Financial statements.
From different periods.
Yeah, from different periods.
When everything's changing.
When the value of money is changing.
Yeah.
You know?
That makes sense.
So CPP helps us like make sense of that.
Okay.
And it uses a general price index.
Right.
To like adjust the figures.
Okay.
So that we can actually
compare?
Yeah, apples to apples.
Apples to apples. Okay.
You know.
Got it.
And they have a really good example in the text of how this works. Like they show you how
like a company.
Yeah, like a company's assets and liabilities and income statement items. Like adjusted using the price index.
Interesting.
So it's pretty cool.
So you can actually see the impact of inflation.
Yeah.
Okay.
Another concept that I thought was interesting was current value accounting.
Current value.
Which is basically like...
So we're not using historical cost.
Not using historical cost.
We're using like what it's worth today.
What's it worth today?
Okay.
And they actually talk about like different...
ways to do that.
Ways to determine current value.
Okay.
Like net realizable value.
Okay.
Replacement cost. Value in use.
Okay, so like different ways of looking at what something is worth today.
So net realizable value is like what you could sell it for.
Today, minus any selling costs.
Yeah.
Okay.
Replacement cost is what it would cost to replace it.
With a brand new one.
Yeah. Value in use is like what's the present value of the future benefits you're going to get.
From using the asset.
Yeah.
Okay. So
depending on...
Depends on the asset.
The asset and the purpose.
Yeah.
You might use a different
method?
Method. Okay.
Yeah.
That's interesting.
So, and then the last concept that I thought was really important was capital maintenance concept.
Capital maintenance. Okay.
Which is basically like,
how
do we define capital?
Define capital.
And like, what does that mean for like profit and performance?
Okay.
You know?
Yeah, that makes sense.
And they talk about like a few different ways to define capital, like money capital, purchasing power capital.
Okay.
Physical capital.
So like different ways of looking at what we're trying to maintain.
Yeah.
Interesting.
So money capital is like just the nominal amount of capital.
Okay.
Like you put in $10,000.
You want to have at least $10,000 at the end.
Okay.
But it doesn't take into account like
inflation.
Yeah. You know, so purchasing power capital is like, okay, well, we want to make sure that those $10,000
can still buy the same amount of stuff.
Even if prices have gone up.
Yeah. Okay.
Even if prices have gone up.
That makes sense.
And then physical capital is like more about like the productive capacity of the business.
Okay.
Can you still produce the same amount of goods and services?
Okay.
You know?
Yeah, that makes sense.
So it's not just about the dollars.
It's about what you can do with those dollars.
Yeah, what those dollars can actually do.
Yeah, okay.
So I think we've covered like a lot of
ground
here.
Yeah.
But it really...
This is fascinating.
It's fascinating.
Yeah.
It really is.
I'm learning a lot.
Like these basic concepts are super important.
Absolutely.
For understanding and counting.
Well, the whole field.
The whole field, yeah.
Okay.
And it's really making me think about like how these concepts like play out in the real world.
In practice.
Yeah, and like what are the implications for businesses and investors and all the stakeholders?
Yeah. This has been a great overview of like the basics.
We've laid the foundation here.
Yeah.
For sure.
Awesome. I'm ready for more.
Okay.
Let's keep going.
All right. We'll be back.
It's good.
In the next part of this deep dive. Can't wait. All right.